Today's session is about investments and financial assets. When companies have extra cash, what do? Well, they do not put it in the pillow, of course. Money in the pillow is wasted and does not yield any return. You got excess cash? Great. Then you invest. Investments by companies are classified into three categories, depending on the characteristics. If you own 20% of an entity or less, let us say you buy one share of Microsoft, then this is classified as a trading security. This classification yields a unique accounting treatment, but it does not have to be an investment into a share of another company. You can also buy bonds, money market funds, or any other investable asset class that you fancy. You want to do crypto, that is also classified as a trading security. So long as you own less than 20%, then it is a trading security. Next, if you own between 20% to 50% of another company or asset, then this will be classified as an investment using the equity method. Another term commonly used for these types of investments is investments into associates. These types of investments, where you own a lot of something, but not enough to establish control, has its own particular accounting treatment. Finally, if you buy 50% or more of another company, then the accounting treatment will be completely different, and then the company will be consolidated. Today's session will deal with trading securities and investments using the equity method only. For more than 50% ownership, M&As, I'll record a separate video, as it is long and complex. All right, let us first start with the trading securities. Assume you buy one share of Apple stock for $100. Well, if you spend $100 buying something, then you have less cash. The corresponding entry will be $100 more of a trading security under assets on the balance sheet. You are not richer, so equity is not changed. You neither touch liabilities since you do not have more debt. Buying something does not lead to performance effects, so the income statement is not affected. Since we spent $100 of our cash, then this cash outflow would show up on the cash flow statement, and that would come up under investments as minus 100. Apple is traded on the stock exchange, so its price changes every single day. Assume you wake up the next morning and you see that Apple's price has gone up by $20. Well, for trading securities, any gain on the investment is reflected on the income statement, which is now higher by 20. This goes under financial income, normally netted against interest expense. Remember, if something hits the income statement, we have a mustache, so the balance sheet and the cash flow statement are all affected. Under equity, we have retained earnings higher by $20. And the net income line, which is at the top of the cash flow statement item from operations, also is higher by 20. However, this does not mean that we have more cash. Our income is higher, but cash is not. Apple going up in value by $20 does not increase our cash. So cash flow from operations is zero. We have to make an adjustment, minus $20 to non-cash gains. And now the cash flow statement from operations is zero. On the other side of the balance sheet, trading securities goes up by 20, and this balances with the increased 20 under equity. The following day we wake up and Apple's price is now lower by $30. We do the opposite transactions as in step 2. Income is less by 30. We do the mustache. Retained earnings under equity is less by 30. And the net income under the cash flow from operations is minus 30. We need to make a non-cash adjustment to bring the CFO to zero. Trading securities under assets is now lower by 30, and it balances with the lower 30 under equity. Apple has paid dividends. You are happy. You now have cash. Dividends are $5. This will be classified as a $5 gain on the income statement. The mustache again. Retained earnings is more, and net income in the cash flow statement from operations is more also. This time, it is a cash gain. Under IFRS, the cash gain goes normally under the cash flow from investments. Actually, IFRS allows both. Companies can choose to classify under operations or under investments. I hated that IFRS gives you the choice, as if accounting was not confusing enough as it is. In US GAAP, we do not have the choice. It has to go under operations. The particular treatment you see here is the IFRS treatment where the company chooses to classify it under investments. We wake up and decide to sell the investment. The last book value of the trading security is 100 plus 20 minus 30 gives us 90. That is the last recorded value in our books. We sell it for 150, which is Apple's current market value. We register a gain of 60 on the income statement. This would be 150 sale price minus the 90 book value. The 60 gain on the income statement gives us a mustache, 60 under retained earnings, and 60 under the cash flow from operations under net income. Now you have to remember, the cash we get is 150, and that goes under the cash flow from investments. Under cash flow from operations, we have a plus 60 gain that is non-cash. So we have to subtract to bring the cash flow from operations to zero. There is no operational cash in this transaction.